let's connect with Adrian Mowat. And it's always a delight and a pleasure to have him on ET Now. Adrian, welcome to the show. Thank you for joining us. Adrian, it's a tug of war between stocks and bonds, which is causing this shakeout in equity markets. So do you think the storm has come and gone, or this could be a long winter ahead?
I think the bulk of the storm has probably gone. So if we just recall what's happened here, we had quite a large move in US 10-year bond yields based upon what was strong economic data, particularly the labor market data, which did show some wage inflation. And I think anecdotally, you've been hearing that companies are going to give part of the tax benefit to their employees. So US bond yields go up by 40 basis points very quickly. Investors pause to consider what that means. You begin to get a correction. You then have leverage within the markets. We have various different structures in which those structures leverage increases when volatility is low. When you get a vol shock, you then get these very quick corrections in markets. Remember, this is all about the United States. I think the Asian markets, the emerging markets, are reacting to the S&P rather than being driven by their own fundamentals here. So we've had a deleveraging process. It was pretty vicious last week. I think the macro data that investors will look at going forward, obviously, will be inflation. Tomorrow, Valentine's Day, we've got a whole series of CPI numbers coming out. Clearly, it'll be the core CPI that's going to be important, plus the PCE deflator, which the Fed tends to like to watch. And perhaps that could give the market a little bit of comfort. Bond yields perhaps come down a bit. And then I think we'll be past the worst of this volatility shock.
Adrian, about two and a half years ago, the world was worried about inflation not coming back. We were openly using terms like negative interest rates. Now that growth is making a comeback, rather than rejoicing it, everyone seems to be worried.
Yeah, look, I think you make a very important point here. This is generally a good news story. If there is pricing power in the US, it's probably going to be good for US profit margins. If the consumer is being paid a bit more, then that should also be good for growth rates. I think the issue here, and let's not forget that January was an extraordinary good month. Equities rose very, very rapidly. So we're pricing in a fair amount of good news. You then got a rapid move in the bond market. As I was talking earlier, you've got instruments within the equity markets that can cause more rapid movements. And I think that's what we've seen. So as we move through the first quarter and begin to recognize that the macroeconomic environment is still a good one, that a steepening yield curve, I think one of the issues we have here when we talk about yield curves is you have to be quite old to know what a steepening yield curve means. We went into quantitative easing coming out of the 2007, 2008 financial crisis. Many people can't remember what it's like when interest rates rise. Between 2003, interest rates went from 1% to 5.25%. During that period of time, you had periods of volatility, but capital markets did well, particularly equity markets, because it was generally in a favorable environment for profits, which are clearly very important for driving equities. Where we're concerned about interest rates is obviously that's our risk-free rates, and that can have a valuation impact. But I think the valuation impact of bond yields sub 3% is very modest on equities.
Adrian, hi, morning. Aisha as well joining in from Mumbai. So that's the global part of it, Adrian. But what's also perhaps impacted India, and I would like your opinion on this, is the fact that the budget not just had a populist tone, but it also slapped a 10% tax on equities in the form of long-term capital gains tax on both mutual funds as well as equities. Would you say that that also could be a deterrent for investment into India, or not quite?
Yeah, it's a good question. Remember that India is one of the emerging markets where the tax situation has remained poor relative to other emerging markets. We've had all the discussion around P notes, the use of the Mauritian tax treaty, etc. So I think we've got a fair amount of scar tissue when it comes to Indian tax policy as investors in India. Long-term capital gains tax, it's difficult to assess whether this is good or bad for equities. You will get a situation here that if you are an investor in Indian equities and you've held a position for a long period of time, you're discouraged from selling that position because you have to pay capital gains tax on it. And that lack of supply may actually be okay for prices. So I wouldn't play too much into the tax story. I think what you highlight with the budget, we do have the clock ticking for the next general election. It is reasonable that the incumbent government does have a budget that increases their probability of being re-elected. So I don't think we should be surprised by that. I do think, though, that investors continue to be a little bit frustrated that the Indian growth story is not quite as dynamic as they've been hoping. We do expect okay earnings for the first quarter, but that's really much more of a sort of base effect rather than something that's sort of telling us that there's an acceleration in the dynamics of the Indian story. When I was sort of looking at markets late January, remember India was quite a big laggard. So I don't think it's the sort of interesting dynamic delta story that investors have been chasing.
Oh yeah, absolutely. You highlighted the pros and cons quite out there, as open as it could be. So what is it that you do as an India investor right now, Adrian? Because you know that growth story has been a little slow, but having said that, there is earnings growth in specific sectors and companies. And the overall forecast for earnings for FY18 continues to be about 19 to 20% on the index basis. We all know that this was meant to be an election budget, and we all know that the clock has already begun ticking when it comes to elections. So the spending focus of the government is going to completely change. What then, in that case, do you do as an India investor?
Well, it's interesting sort of listening to your story, your show earlier today. We're seeing a very mixed results season. And one of the earlier commentators was just sort of highlighting how quite stock specific it is. And it's difficult to make a comment saying you should buy banks in India or you should sell banks in India because it doesn't appear to be a consistent trend in terms of the results that are coming through. So I think it's a market that I think is not going to do particularly well this year relative to other emerging markets. One in which the strong stock selector may prosper, but very difficult from a strategy perspective to see which sectors prosper in this environment, which is slightly less growth than perhaps people were expecting, and a little bit more of a political overhang.
Adrian, you've been a long votary of the fact that Indian earnings were about to recover, and now we can see decisive move in the right direction. The fact that earnings recovery is dawned on us, what is coming next? Could cyclicals make a comeback? Could wholesale banks make a comeback? So for investors, how can they play this earnings recovery theme in India?
Well, first, let's be careful about this recovery because we do have a very favorable base effect, particularly with bases such as demonetization causing a fair amount of volatility. Let's not also forget that there was a shock to global emerging markets coming out of the US election in late 2016. So yes, there's an acceleration, but I think part of that optics is this easy base effect. So I'm not willing to call this a sort of new cyclical higher growth story because of that base effect. I think we're going to need to, look at the quarter over quarter numbers to see if there really is a meaningful change rather than just an easy base effect.
Adrian, the fact that global growth is the highest in a long, long time, do you think now there could be a downside risk to global growth, or do you think the momentum is here to stay and global growth will surprise us like it has in better part of 2017?
Yeah, so first thing I'd highlight is I don't think it's a synchronized story. Yes, global growth on average is stronger than we've seen for a protracted period of time. I think that the dynamics that are driving Europe, Japan are not necessarily in sync with what's going on in the US. But to address that issue specifically, I am anxious that the US growth rates do slow down. You know, the US is moving, has given its economy a boost through deficit spending through this tax cut. Yes, that's great for this year, but as the deficit rises, as some of these tax provisions get rolled back, if you think about 2019, the flexibility in policy is definitely less. You combine that with rising rates, and I think you probably have seen the best for US growth. The story in Europe is still one of a gradual build in momentum, but the story in their momentum may be hit a little bit by the strength that we've seen in the euro, and in Japan. I think the story remains interesting. It's slow recovery within emerging markets. The China growth story has been good. The profitability story has been good. But I'd imagine that the March PMI will probably be lower than we saw coming out of December. It's always a little bit difficult looking at March and February because of Chinese New Year. So a long answer to the question, which is really, do you think growth is going to slow from here? And I think the answer is yes, on average, across the global economy.
So Adrian, let's shift focus back to India. And as an India investors, what sectors do you pick and not pick? And largely, it seems, especially given the kind of numbers that we've seen from some of the, PSU banks over the weekend, the likes of State Bank of India, Bank of Baroda, which are the largest PSU banks, that asset quality stress remains to be a big concern. And that's a glaring hole when it comes to all these PSB reportage. Would it be best to stick to the quality proven names, the likes of an ICICI Bank, an HDFC Bank, wherein time and time again, you have been assured of the fact that asset quality at least would be intact and you will get a steady earnings growth?
Yeah, look, I think that if we're going to make sort of broad statements across these banks, that's the correct strategy, to stick with the quality and not take the sort of risk that you get another negative surprise on asset quality. I think, though, it's always very important to remember that you can make very good money out of financials if you do buy them when the share price has been very adversely affected by announcements on asset quality. I think it's probably too early to say that that is the case for these PSU banks. I mean, they are underperforming, but I don't think they're so cheap that they're compelling buys on this bad news.
Yeah, seems to be the case. The other story that is really held intact all of 2017 and continues to do so, Adrian, has been metals as a pack. Now, this seems like a global trade at play, and the likes of Tata Steel, the entire cluster, in fact, without getting into specific names, has been holding out well. Would you say that at this time, perhaps it's best to align your portfolio to some of these global trades? The baton seems to be with metals, and you would be safe if you stay with that sector.
Well, previous question was what's my view on global growth, and I do think there's a risk that we're at the best levels. So that's a cautionary note if you're thinking about commodity plays. I would argue that what drove metal prices, particularly prices such as aluminium, steel, has been the behavior of the Chinese government. China's in the process of forming oligopolies, improving the return on capital for many of its public sector units, or as they would call them, state-owned enterprises, which is crucial for protecting the Chinese banking system. And so the likes of a Tata Steel has basically had a pricing umbrella from the Chinese. And I think that theme continues. I think that's more of a secular story. But I would caution those that are very long metals that if my proposition that global growth is probably peaking at this level, that tends to be a little bit of a headwind for commodity prices.
Okay, Adrian, what to your mind is our projected, return expectations one should have from Indian consumer staples and consumer durables? Some of the consumer staple and durable companies are great companies, but HUL is trading at 66 times. A name like Britannia is trading at 40, 50 times. What should one expect from these companies?
Well, I think one has to expect over time that P multiples begin to normalize. And so even if they have a high underlying growth rate in their earnings per share, the probability of you on a 3-year view making good money out of these stocks seems low. Just a reality check, look at these valuations levels. Now, I do think, though, we need to go back and talk a little bit about politics and how that might impact the consumption story. So we've had a relatively good consumption story for urban India for the last couple of years, whereas rural India has generally been quite weak. So I think there's a degree of a handover, particularly in a political year, towards the rural consumption story. So I think you might see rotation within the consumer names. But if you're asking me about very expensive stocks, at some point valuations do normalize and you're not helping your probability of making a good return on a 3-year view by buying very expensive stocks.
Adrian, between IT and pharma, where are you more confident? What do you think has better entry points and return propositions could be decent?
Well, when we talk about IT in India, we're talking about software services, which continues to have some structural challenges. Within the IT space, there's obviously different management approaches to that. And so I think it's becoming quite difficult, again, for the strategist to comment on the specific underlying company strategies and which will be more or less successful on the IT space. I think on the pharma space, hopefully we've moved away from some of the noise around US policy, and perhaps the policy environment becomes a little bit clearer, and then that allows the companies with the better new molecules, etc., to do well. We've also got some of the bigger pharma names have been through that consolidation phase after some of their M&A strategies. So I'll tend to be more attuned to looking at pharma rather than IT at this point in time if I'm looking for exporters from India.
Howard Marks once told me that the best gains are made when you simply stop analyzing or stop over-analyzing, buy stocks and hold them for a long period of time. Now, you've been tracking India for more than 20 years. What to your mind will still qualify as buy and hold stocks for the next 3 to 5 years?
Well, you've got some of the high-quality finance names, the usual stories like the HDFCs, which has sat in that dynamic. If we think about sort of buy and hold in the pharma space, it's been something like Sun. I was an investor back in India in the early 1990s, and that was one of our favorite stocks, had continued to perform well, saw some challenges more recently. I think in terms of the IT space, unfortunately, they seem to have fallen out of the buy and hold category as they're challenged by the developments that are going on in terms of cloud computing, in the way that the corporate sector globally buys IT services. So they've kind of fallen out of the buy and hold camp. I think the other area to look at for buy and hold would be the insurance space, where you have got a very underpenetrated market for insurance products. Admittedly, the addressable marketplace is probably more modest than some of the bulls talk about. But I think those can be very interesting compounding stocks over the longer term.
indeed a pleasure and a delight to have you on ET Now. Certainly hope to get more of you, and it was always, it's always a pleasure getting a big picture in your thoughts.
Pleasure. Thank you very much.